Hello friends, we will continue our discussion on the chapter of admission of a partner. Right? In the last lecture, we started our discussion on the topic of goodwill. So what is a goodwill? I explained that goodwill is a reputation. Goodwill is a reputation of a business that has been earned by the partners over a period of time. Right? This reputation is earned over a period of time. Now, what happens if you have a good reputation in the market? You will earn more profits, right? So, if you have a good reputation, if you have a high goodwill in the market as compared to your competitors, then you will earn high profits, right? And there are various other things like the old customers will resort to you, the new customers will get attached to your business. Okay, so this is what is goodwill. Then I told you that in case of admission of a partner, the new partner is joining the firm. As soon as he joins the firm, he will enjoy this reputation that has been earned by the old partners. Old partners worked hard for it, earned this reputation over a period of time, and the new partner immediately comes into the business and he enjoys this reputation, right? So he must pay to the partners. Moreover, the old partners are sacrificing some share of their profits in favor of new partner. So the new partner must compensate the old partners. New partner must compensate the old partners. Compensation for what? Compensation for the sacrifice of the old partners in favor of new partner and for enjoying the reputation of the business that has been earned by the old partners. Now this compensation is known as goodwill, or there is also another name for it. We will say premium for goodwill. Clear? So this is the very basic, that the new partner must compensate the old partners for the sacrifice in the profits in favor of the new partner, and also for enjoying the reputation that has been earned by the old partners over a period of time. Right? So the new partner will pay some amount to the old partners, which we call as goodwill or premium for goodwill. There was another very important point I discussed in the last lecture. That point was goodwill to be adjusted through partner's capital account. Goodwill will not be appearing in the balance sheet as per the accounting standard on the intangible assets, that is accounting standard 26. It says any intangible asset should not be appearing in the balance sheet in the books of the firm if nothing is paid for that, right? If it is not purchased. This way is the goodwill in case of admission of a partner will not appear in the books. It will be adjusted through the old partner's capital accounts. Right? So now we are going to discuss the cases that how the new partner will pay the goodwill to the old partners. Right? How new partner, what we are going to discuss is how this new partner will pay goodwill to old partners, right? This is what we are going to study now. In this, the first case is goodwill is paid privately. Right? That means goodwill is paid under the table. Right? So there were two partners, A and B, who were running a business. A new partner, C, who is a very, very good friend of A and B, joins the business. Now he, as per the rules, he has to pay the goodwill. Right? What he does is, C pays goodwill to A and B under the table. This is table. From under the table he pays goodwill to A and B. Will this goodwill come into the books of the firm? Any transaction under the table, will you bring these transactions in the books of the firm? Can you think of it? Any transaction which has been done under the table, will you bring those transactions to the books? No, friends. We can't bring those transactions into the books because these transactions are done privately, under the table, no record. Okay, so if the goodwill is paid privately, what you have to do is no recording in the books. Clear? If the goodwill is paid by the new partner to the old partners privately, then you have to do nothing, you have to record nothing in the books. Do not bring that goodwill in the books. Do not adjust that goodwill at all. You have to do nothing. Just take the money of goodwill, put it in your pocket, forget about it. That's it. Right? Take the money, keep it in your pocket, forget it. C is the new partner. Clear? So this was case 1 where the goodwill is paid privately. Now let's see case 2. Case number 2 is goodwill is brought in cash and retained in business. Right? Goodwill is brought in cash and retained in business. Now what will happen? Who will pay the cash? New partner, because he has to compensate the old partners. So if the cash is coming into the business, we will debit it or credit it. We will debit the cash or credit the cash. We will debit the cash. Why? Because as per the rules of accounting, debit what comes in, credit what goes out. So the cash is coming in, I will say cash account debit, and who is the giver? We say debit the receiver, credit the giver. Who is the giver here? New partner. I will say cash account debit to new partner account. This is, I have received cash from the new partner. Cash for what? Compensation. Right? Now, what I will do is, I'll replace this new partner with premium for goodwill. Why? What is he paying cash for? Goodwill. Right? What is he bringing? Cash for goodwill. So I will replace this new partner with premium for goodwill. Clear? So my entry will be cash account debit to premium for goodwill account. Clear? Next thing, next entry. Now, who are the sacrificing partners? Old partners. This compensation, this premium for goodwill that has come in the form of a cash, this is for old partners. So this I will transfer to the old partners capital accounts. Rule 1, goodwill not to appear in the books. Rule 2, goodwill I will adjust through the partners capital accounts. That's what I am going to do now. This premium for goodwill is for the old partners who are sacrificing in favor of the new partner. So I will transfer this premium for goodwill to the old partners capital accounts. I'll say premium for goodwill account debit to old partners capital or current accounts. Right? Now see, there are two old partners, say A and B. Now the question is, in which ratio this premium is to be divided among the old partners? In which ratio? Write down this question. In which ratio this premium will be divided among old partners. Now, can you think of a reason? Can you think of the answer to this question? That in which ratio this premium should be divided? According to you people, in which ratio this premium should be divided among the old partners? We have discussed the new profit sharing ratio. We have discussed the sacrificing ratio. So you can tell me in which ratio this premium will be divided among the old partners. Okay, I'll tell you. See, who are the sacrificing? Old partners, right? This premium is going to the old partners. Why this premium is going to old partners? Because they are sacrificing some part of the share in favor of the new partner, right? So what is the main point here? What is the main word here? The main word is sacrifice. Everything is revolving around this sacrifice. This premium is goodwill is for sacrifice. Sacrifice by whom? Old partners. So this premium will be divided among the old partners in sacrificing ratio. Clear? So what is the sacrificing ratio? That we have discussed in the previous lectures. It is the old share of a partner minus the new share, right? This is sacrificing ratio. In the sacrificing ratio of the old partners, we will divide this premium. This is a very, very important point. Please keep this in mind, that you have to distribute this premium for goodwill among the old partners in sacrificing ratio. See, everything is revolving around the sacrifice made by the old partners. This premium is paid for sacrifice by old partners. Therefore, this premium will be distributed among old partners in the sacrificing ratio. Clear? So you can note this down, that this premium for goodwill will be distributed among the old partners in the sacrificing ratio. Right? First of all, the new partner will bring cash for the premium for goodwill. Then this premium for goodwill will be transferred to the old partner's capital or the current accounts in the sacrificing ratio. Why? Because this premium for goodwill is for the sacrifice made by the old partners. The new partner is compensating the old partners for the sacrifice. Clear? What is the sacrificing ratio? Old share of the partner minus the new share. This we have discussed in detail in the previous lectures, right? Now, another question is, what will be the share of the new partner in the goodwill? Or I can say amount of premium. Amount of premium to be brought by new partner. What will be the amount? This will be equal to total goodwill of the firm multiplied by his share in profit. Remember this pizza example I explained. There is a pizza, 1, 2, 3, 4, 5, 6 slices. Two friends A and B, they decided to eat this pizza 3 slices each. Suddenly a new friend C joins them. He takes 1 slice from A, 1 slice from B, and C pays for these 2 slices. C will not pay for the whole pizza. He has eaten only 2 slices. Why will he pay for the whole pizza? Simple. Same is the logic. This is the whole pizza. Goodwill is whole pizza. This is share of C in pizza. Clear? What is his share in the profits will multiply with the total goodwill. He will pay only that amount as the premium for goodwill. Okay? This new friend, he will not pay for the whole pizza. He will pay only for the slices that he has taken. Similarly, the new partner will pay the premium for goodwill only for that part which he is getting out of the profits. Clear? This will be the amount of premium for goodwill to be brought in by the new partner. Clear? One more small point we have is very simple logic that we discussed in change in profit sharing ratio also. Old goodwill appearing in the books. If on the date of admission of a partner, if there is any goodwill that is appearing in the books of the firm, what we have to do with that? We have to simply write off this goodwill, because this goodwill was earned by old partners before the admission of a partner. This goodwill was appearing in the balance sheet before the admission of a partner. This is a new beginning with a new partner joining the firm. So we will write off any old goodwill that is appearing in the books. How to write off? A simple journal entry: old partners, capital, account debit to goodwill account. Now in which ratio this goodwill will be distributed? Can you think of? Very simple. Anything that is earned before the admission of a partner, in which ratio it will be distributed? In old ratio, because this was before the new partner is joining the firm. So anything before that will be distributed among old partners in old ratio. We will debit the old partners capital accounts for writing off the goodwill. We are writing off an asset. If the asset we are writing off, we will credit the asset and debit the partners capital account. All the adjustments of goodwill we will do through the partners capital accounts. If the premium for goodwill the new partner is bringing, we will adjust it through the partners capital account. Any old goodwill appear in the books, we will write off through the old partners capital accounts. Clear? So in the next lecture, we will do some practical problems on this case number 2. Right? Practical problems on case 2. That how the new partner will bring the goodwill and how it is retained in the business. Clear, friends? So this was case number 2, where the goodwill is brought in cash and retained in the business. If you understand the journal entries, then making the capital accounts and the balance sheet of the new firm will get very easy. Okay? Try to understand the logic behind each and everything. Right? The new partner is bringing the premium for goodwill in cash. Bringing for whom? Old partners. We will transfer this premium for goodwill to the old partners capital accounts. Simple. In which ratio? Everything is revolving around sacrifice. Everything is done for sacrifice. Therefore, we will divide this premium for goodwill in sacrificing ratio. What is the sacrificing ratio? Old share minus the new share. Right? Easy. What will be the amount of premium brought in? Total goodwill into share in the profit. The new partner will pay only for the share he is getting out of the profits. Right? Then if any old goodwill is appearing in the books, write off that goodwill. How to write off? Through the partners capital accounts. Which partners capital accounts? Old partners capital accounts. Why? Because this goodwill belongs to a period where the new partner was not in the picture. Old partners earned that goodwill, they showed that goodwill in the books. So we will write off. Right? So in the next lecture we will do the practical problems. Thank you, friends.